Get Rich Education is brought to you by Norada Real Estate, the Real Asset Investor, and Highlands Residential Mortgage.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's Norada realestate.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
You are inside Get Rich Education, episode 133. Hi, I'm your host, Keith Weinhold, and today you're finding out the latest on what it takes to qualify for an income property loan for yourself on single-family homes up to fourplexes with one of the most seasoned mortgage loan officers on income property loans in the nation. Now, I think you know that I'm not much of a prediction sort, but personally, I think that real estate will keep appreciating for a while into the future here. Although I don't think that we're going to see the rates of appreciation be as high as they have been in recent years. Today, we've got far more responsible lending practices that continue to prevail, unlike what was going on about 12 years ago or so. That's just one reason. And, many markets still have prices below their 2006 peak prices. And that's even more true that today's prices are lower when you adjust for inflation. But where do you find an income property with the right team and in a good market? That is at the brand new GREturnkey.com, where you can connect with about 7 or 8 different providers there. Now, it's been 7 or 8 months here since we've talked about qualifying for income property loans on the show. Today, I think that you're going to learn that you can make lower down payments and have lower reserve requirements on income properties than you did last year. Interest rates are certainly an important consideration for any investor, no doubt about it, but obviously it's not all about interest rates. I mean, just look, in the 1980s, interest rates were 16 to 18%, and people were buying. And then maybe, just a few years ago here, when rates were 4%, people were not buying, 5 or 6 years ago after the mortgage meltdown. So it's about affordability, and it's about enough people that have sufficient credit. I'm doing today's show from what I think is one of, if not the most underappreciated cities in the United States. That's here where I am today in the terrific, historic metro of Philadelphia, Pennsylvania. Our guest is in Texas today. He's truly one of the preeminent mortgage loan officers for income property in the nation. So let's dig into the details on how to best position yourself for income property loans. Today's guest has been a mortgage loan officer for more than 19 years. Respected industry-wide, he has quite a following among real estate investors like us because he specializes specifically in income property loans. He joins us from Dallas, Texas today. Welcome back to Get Rich Education, Highlands Residential Senior Mortgage Loan Officer, Graham Parham.
Thanks, Keith. It's always a pleasure to come back.
Graham, for years now, Get Rich Education listeners have been calling your team because you know what it takes to just kind of plow straight forward and get income property loans closed and done. And you work with pretty much all of those providers that we let our audience know about there at GREturnkey.com. So, Graham, I want to preface today's show with just that exactly. Today's discussion is specifically about 1 to 4 unit income properties, and we're not generally talking about owner-occupied primary residences here. So these are single-family homes, duplexes, triplexes, and fourplexes that are rented to others. And not too long ago, and since you were last here, we had a change in the space with the percents down that we can put on those properties. Tell us about that.
That is correct. Just kind of take back in history, back in 2008, when we had the knee jerk, so to speak. Prior to that, both Fannie Mae and Freddie Mac would allow for 10 loans per borrower. And then when the adjustments came around in 2008, they throttled both of them back to 4. And then 6, 8, 10 months later, Fannie says, no, we're going to take you back to 10. They put a little bit more constraints on that, but it still worked up to 10. So we rocked along for many years, having Freddie Mac only doing up to 4 and Fannie up to 10, which prohibited a lot of the lenders, especially the big banks, to stop their borrowers at 4 because they needed to have 2 buckets to deliver to. So Fannie Mae, about, I'm guessing, a year and a half ago, maybe less than that, decided to take it up to 6, which was a good thing. So Fannie Mae, not too long after that, recently followed back up to 6 instead of going 1 to 4 and then categorizing it from 6 to 10. But what they did, the old 1 to 4 Fannie Mae guideline was you had to have a 20% down on single families and 25% down on 2 to 4 units.
Okay, and just to clarify, that's the first, second, third, and fourth financed properties.
Correct. Now we can take it all the way to 10, where the single family still can be purchased up to 10 at 20% down. The 2 to 4 units are 25% down. The only difference is on loans 7, 8, 9, and 10 that they do have to have a credit score of 720 or higher. It's the only thing that's still the same. So a lot of the lenders or a lot of the borrowers, let's say they're doing some exchanges and they want to buy 4 or 5 properties. Well, they want to spread that money out accordingly. Now they can spread it out a little bit better because they don't have to provide 25% down. They can still do 20.
Okay, so on the first through sixth finance properties, it's 20% down or 25% if there are any duplexes, triplexes, or fourplexes in there. It's the same with the percents down when you get to the 7th, 8th, 9th, and 10th properties. However, the credit score requirement jumps up from where you just need a minimum of 620 on the first 6 properties, or for numbers 7, 8, 9, and 10, now it jumps up to where you need a 720 for those down payment thresholds.
Correct. And also, in addition to prior to this change, when we were doing the 1 to 4s and then the 6s to 10, they had reserve requirements that were a little higher on the 6 to 10. Very much that same time they changed everything, and they did change them a little bit differently than what they did before. What they did before is the requirements 1 to 4 was 6 months of principal, interest, tax, and insurance times 6 for the subject property, and 2 months on every other property they owned under 4. And then when it went to the 6 through 10, it used to be 6 months principal, interest, tax, and insurance for all properties owned. Now they've made the changes where it's a different calculation.
Okay.
For multiple properties, regardless if it's a 1 to 4 or 6 to 10 or whatever the case may be, they've segmented it into 1 to 4 with a unpaid aggregate loan amount that's outstanding. And let me explain what that means. Let's say a person has a primary residence and they had 2 investment properties. So they have a total of 3.
Okay.
They're doing their 4th investment properties. The 2 investment properties they have loans against, let's just say the balance on both of those equate to $100,000. Let's say they were 50 apiece. So they have an outstanding balance on the 2 investment properties of $100,000. So through the 1 to 4 number of properties, the new reserve requirements is we do a multiplier against that unpaid balance at a multiplier of 2%. So 2% of $100,000 is $2,000. The good thing is a lot of the lenders out there will include the primary residence into those numbers for reserve requirements. We do not. So if you have $500,000 on your primary residence, we don't count it.
Good.
Only those investment properties and second homes. Then when you go from loans 5 to 6, then that multiplier goes from 2% to 4%. Same example. If you have $100,000 balance on 5 loans, then the multiplier is a 4%, so the reserve requirements would be $4,000. And then it jumps to the 7 to 10 range, and that jumps up to a 6%. So it's very, very important that investors understand this because they, I've got enough money to make where I can put down for 3 properties. Well, you still have the reserves to deal with, okay? And if they were any kind of seasoned investors up to the last, say, year and a half, they're in the back of their mind thinking, okay, I need 6 months principal, interest, tax, and insurance. Well, some of the other changes that came around that's a benefit to the investor is that a lot of times they were using their tax-sheltered asset, IRAs, 401ks, anything that's not liquid, as their reserves. but the Fannie Mae community would only give you 60% of the asset.
Right.
If it was $100,000 in your 401k, we would only give you $60,000 as a reserve. Now it's up to 100. So they give you the full asset value, which is good.
To use toward your reserves.
Correct.
Okay, so it sounds like things have gotten more lenient with the reserve requirements. We now have these requirements based on the unpaid balance outstanding on your other income properties. And those requirements, 2% at 1 to 4 finance properties, 4% of the unpaid balance at 5 to 6, or 6% of the unpaid balance for 7 to 10 finance properties, are more lenient than what it had been.
That is correct.
Primary residence not included in the calculations, just as a reminder there. And, I just want to let the listener know, listen to the phrase Graham and I are using. We're using the phrase financed properties when we're talking about these numbers here. We're not using the term loans because, remember, one income property could have 2 loans on it, and that's not what we're talking about. We're talking about financed properties.
Correct. And another thing that you might want to understand is back years ago, a husband and wife would come to the party and say, you know what? Fannie Mae allows us to have up to 10 loans, so I'm going to do 10 and she's going to do 10. Okay, fine. And it used to be we would just go look at the credit report. If we see less than 10, we're good to go, and we move forward. Fannie Mae also made a change about a year and a half ago, almost 2 years ago, where it's called the entitlement of finance properties for 1 to 4. So as an example, husband goes out and buys a property in his name. When he goes to close, he's decided to go ahead and just put his wife on title. Well, now husband and wife own that one property, but the loan is strictly in the husband's name. Well, that's taken away one slot from the wife, because if it's a 1 to 4 family residential property and that wife is entitled and she wants to go do her 10, she can only do 9. So keep that in mind. I see that happen a lot. People that are doing trust, they want to put their loans entitled in the trust. Well, guess who owns the trust? The husband and wife. Same with they want to post-close and put it into LLCs. Well, guess who owns the LLC? The husband and wife. So keep that in mind when you're trying to grow your inventory.
Okay, that's a good consideration for planning. Well, Graham, I know one thing that often holds up people from getting more loans in the past has been, they might have the down payment, they might have the reserve requirement, they might have the credit score, but it's that DTI, it's that debt to income ratio that sometimes hangs people up from adding more investment property to what they want to have. And, sometimes people want to go ahead and take a home equity line of credit off their primary residence and go ahead and use that to purchase more income property and increase their velocity of money and get arbitrage that way. Are there debt-to-income considerations when one goes ahead and tries to do that, pulls a HELOC off their primary? Tell us about that.
Yes, but not as bad as you would think. I love HELOCs. I think everybody should have them. I just recently am still going through the process and hopefully finishing up here in the next 30 days. I sold off almost 3/4 of my inventory because I wanted to realign my products because I've fully depreciated a lot of them, and it just made sense for me to do some upgrades. And so consequently, I'm going through exchanges, and I didn't know exactly where my exchange money would end up because I'm trying to max my 10 loans out again. So I went ahead and got a HELOC before I started doing all my loans. So I got it approved. It's up to $100,000. It's just sitting there with a zero balance. Now, what I'm going to use it for, other than what you're referring to, well, it's kind of the same thing actually. On my 10th property, closing here in the next 30 days, but I saw another one that I really, really liked, and it's for $150,000. I've got about $100 in the bank, but I can't get a loan because I'm maxed out. This will be property number 11. So I'll just tap into my HELOC and use the rest of that, okay? And then eventually I may just pay the HELOC back. A lot of times what people were doing prior to the mortgage meltdown, that's all they were using, because all the equity positions that everybody had, especially on the West Coast, they were getting these monster HELOCs, $200,000 and $300,000 HELOCs, and making use of that money for down payment. I think they're great. A lot of people will say, well, it's a variable rate loan. If you put prime plus whatever they're offering together, it's not as attractive as if it was cash. I don't agree with that. Leverage is your friend, okay?
Yeah.
Make use of it.
I totally agree with, in most cases, really optimizing that leverage. And I agree with you, Graham. And I think we talked about this before when you were on the show. I mean, there's almost no point to not having a HELOC. One can go ahead originate a HELOC on their home, keep it at a zero balance if they want to, but yet they have that flexibility of using it for anything from an emergency to an income property. And the fees associated with originating a home equity line of credit are also really low. So there's almost no reason not to have one, whether it's used or not. And, I think you can tell that Graham is an active income property investor himself. So he knows what you need as an income property investor. And Graham, why don't you tell our audience a little bit about just what the advantages are of using an income property oriented mortgage loan officer versus one that's more used to doing ones for primary residences?
Well, and I'm not here to criticize any of my competitors or loan originators, but yeah, there are originators out there that may do very good volume in the owner-occupied category, and they very seldom do an investment property, but they, are thinking to themselves, oh yeah, I can do a rental property, not a big deal. But if they don't understand some of the quirkiness that we deal with on a daily basis, working with turnkey providers, doing exchanges, doing those properly, there's just a lot of little quirky things. If they don't understand it, they can run into issues to the point where they may or may not be able to fund the loan. So having that knowledge, and this is all I do, is work with investors, I can see those roadblocks coming and identify those roadblocks up front before you make loan applications. So that's why during the interviewing process that I'll go and ask all these necessary questions so we won't waste anyone's time. Bottom line.
Yeah, so you really want to talk to someone like Graham that's in the market and knows just what to expect. When Graham and I come back, we're going to talk more about that. We're going to talk about mortgage sequencing. For example, if you buy a property in Memphis today and you want to buy one in Jacksonville next month, how should you consider that? What should you plan? And how are investor interest rates higher than owner-occupieds? And what's that spread today? You're listening to Get Rich Education. Our guest is Highlands Residential Mortgage Senior Loan Officer Graham Parham. When we come back, I'm your host, Keith Weinhold. Are you looking to invest in your first investment property or grow your existing inventory? Highlands Residential Mortgage can help, offering down payments as low as 15% and credit score requirements down to 620. Their streamlined process is designed to help investors close their loans quickly and without any surprises. You need someone who knows cash flowing real estate and can help guide you through the muddy waters of today's lending environment. So call Graham Parham today, toll free at 855-326-6802. The Parham team can help you purchase or refinance any of your 1 to 4 family investment properties.
NMLS number 195724, 12001 North Central Expressway, Suite 750, Dallas, Texas 75243. Equal housing lender, not licensed in all states.
As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
This is Cashflow Diaries Jay Massey. Do the right thing, then do things right. Listen to Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education with our guest, Highlands Residential Mortgage Senior Loan Officer Extraordinaire, Graham Parham. Graham, tell us about how investor interest rates differ from owner-occupied ones, and what are the interest rates today? Of course, that's going to change over the weeks and months, and that's going to depend on a number of factors, but tell us about investor rates versus owner-occupied rates today.
That's a very good question, Keith. I've been working with investors for roughly 20 years, and some of them are extremely seasoned, very knowledgeable. This one in particular, I've done a million loans for. He's an accountant by trade, so he's extremely analytical, and he's always trying to focus on what's the best way to go about it. And he'll tell me today, any rate below 7% is still a very good interest rate for an investor, simply because he was dealing, obviously, back in those times in the double digits. So is interest rates going to stay the same? Are they going to go up? I suspect they may move up a little bit more. How much, I can't really say. Some of the novice, or should I say some of the investors that are just getting into the game for the last couple of years, really say 5 or 6 years, we all have been very spoiled. We really have.
Right.
I mean, to see those rates down in the 4s and the 5s, that's unconscionable. But I mean, we've been taking advantage of it. It makes our cash flow work a lot better. It makes it easier for the turnkey provider to present a profitable property. But as far as the rates are concerned today, we did see a little bit of a shot in the arm right before the elections. I can go into great detail on that, but I'm not. So jumped up about 0.75%, and that was a very, very aggressive jump. I haven't seen that kind of jump in many, many years. It kind of plateaued itself out probably in January all the way through about middle of February. Saw a little bit more of a spike, and then it kind of came down again. So I can give you somewhat of an average today, and of course my competitors may call and say I can give you something better or worse. But the rates vary, and I usually try to quote 0-point pricing. And for people that don't understand that, some lenders quote points in addition to their rates to make the rates look good. In essence, you're buying the rate down at the closing table. You're using a percentage or a point to buy it down, which is a multiplier against the loan amount. I try to quote everything with 0-point pricing to limit your out-of-pockets. So we're kind of running in a range somewhere today, fortunately, around probably 4 5/8, which is 4.625, up to about 5 to 5.125. And the reason for the range is because there's several things to consider. Obviously, your credit score. There's a percentage of down, whether it's 20 or 25% down. Loan amount, which is another factor. And, of course, type of property. If it's a 1 to 4 family, you can rest assured you can get the same rate on a 1 to 4 family on a single family versus a duplex, but you're going to have that same rate with a point, whereas a single family would not. Those are normal Fannie Mae adjustments. If you're wanting to get a better rate when you're doing a transaction, always go with the 25% down. People always ask me, can you get a better rate if I go 30? Well, not according to my pricing grid. But typically you can get probably between 1/4 to 3/8 better in rate when you go from 20 to 25% down. All the transactions that I'm doing this last month and a half, 2 months, all been 25% down because it's going to give me better cash flow, a better rate. So I highly recommend looking at that. But for those people that are trying to spread out their dollars and cents on, let's say, an $80,000, $90,000 property, well, when you look at the difference between the payment of 1/8 difference in payment, sometimes we're only talking $5 and $6. So we're not talking a whole lot. So with those kind of people, I would probably recommending, let's do your 20% down, save that extra 5%, and let's take it, put it on properties 2, 3, and 4. There's several schools of thought when it go into doing rates and pricing and so forth. And that's, part of my job to consult you in that area, then let you make sure that you feel comfortable with how you spend your money.
Yeah, I'm typically a person that likes more leverage, but really the answer is it depends and just what are the factors and the adjustments. Okay, so you can take it from a 20% down payment up to a 25% down payment, lose some leverage, and get a better rate that way. So those are just trade-offs that one needs to consider. And when we're talking about rates, back in the 1980s, a lot of people were buying property and paying 16 to 18% interest rates. The godfather of real estate, Bob Helms, who you and I know, Graham, he says anything under 10% is an incredible rate because he's been investing in 7 different decades. When I bought my first ever fourplex building back in 2002, I paid a rate of 6 3/8%, which is 6.375, and people were just aghast and in disbelief that I was paying such a low rate at 6 3/8. So to have non-owner occupied property anywhere around the 5-ish range really is remarkable. So, Graham, there's something with mortgage sequencing that an investor needs to think about when they're building their portfolio, and there are some considerations there and some things that one needs to look out for. So say, for example, a buyer wants to buy property in Memphis today, and they plan to go ahead and purchase a property in Jacksonville next month. How should they plan? What are some things that they need to consider there?
Couple of considerations. First of all, if I did the property in Memphis and then I'm going to do the one in Jacksonville, that's a good thing simply because I pulled your credit for the first one. Your credit's good for 90 days. I'm going to use that same credit, so I don't have to have another credit inquiry. If you went to a different lender and vice versa, then you're subject to having that. And I know a lot of people are extremely conscious about their credit, and they keep thinking, Multiple inquiries will draw the credit score down. And that's true to an extent. But with people with high credit score, high integrity credit profiles, a lot of times you'll hardly ever see that. Another thing of consideration is your cash to close. You want to be prepared that you're going to have enough money to do the down payment, the reserve requirements, and closing costs on properties 2, 3, and 4. Now, if you do a property today in Memphis and you wait 30 days to do one in Jacksonville, and let's say the Memphis property did not have a tenant in it when you bought it, but it was being managed by one of the providers, and needless to say, all the providers that Keith works with, they're going to have a tenant in there very, very fast, within 30 days.
Yeah.
So you're going to get a lease and a tenant in there pretty quick. So what happens after 30 days, we are going to require to get a lease on that purchase property that you just acquired a month ago, because we don't want to count that against you as having the full payment. We want to give you income on that property. Another good reason to come back to the same lender. So keep that in mind. Now, let's take it one step further. Let's say you're buying 3 at a time or 4 at a time, and you're closing all 4 at the same time. And what happens if all 4 are brand new rehab properties? They have no tenants in them. They're ready to go. They're appraisal ready. We've run the appraisal. We've got them into closing when we go to close. So the underwriter will say, okay, well, these properties are all empty. 9 out of 10 lenders will say, okay, the appraisal gives a thing called a market rent analysis. It's called the 1007, and it usually is pretty darn close to what the provider has quoted on the rent ratios and how the rent they're going to be able to rent the property. It's usually close to 1%. So all lenders will give credit on a vacant property on the subject only 75% of the gross rent. Buy a $100,000 property, you've got a $1,000 rent, they're going to give you credit for $750. Well, that typically will offset your principal and interest and tax and insurance. But what they won't do is they'll give you credit for properties 2, 3, and 4, even though those appraisals, we have them, or should I say that lender has them. They've got the market rent analysis on 2, 3, and 4. They won't use that market rent analysis unless it has a lease agreement. It's very, very important. A lot of lenders will not do that. So those are very good questions when you're seeking out, lenders. Hey, how's this going to affect me? Can you do 4 properties at one time? And I say this like it was yesterday for everybody. If I can do 1, I can do 5. And that's how, because I give you credit back and they all talk to each other.
Okay, so that's another advantage of buying turnkey property where the property is typically already tenanted and that lease agreement can be shown.
Correct.
So, Graham, overall, just kind of big picture here. I mean, you've been doing this for so long, more than 19 years. I mean, just kind of big picture, is the lending climate more loose or is it more tight than it was 1 to 5 years ago? Can you give some examples of that and some reasons for that? Tell us more.
Well, we've, touched on a little bit of them, taking the down payment percentage all the way up to 20% for 10. That's a big part of a loosening, so to speak. I feel that with the current administration that we have in place, not to talk any politics whatsoever, Democratic or Republican, but I think we have a lot of the good key players in place to kind of help support loosening up the Dodd-Frank. And that's kind of the key here. The Dodd-Frank bill came into place back in 2010, which really swung the pendulum, in my opinion, and you ask any lender, kind of swung that pendulum a little too far, and it never had a chance to come back. And I think our new administration is going to clip that rope, and that pendulum will start to come back. Is it going to come back right away? Well, we'll see. I think some of the things and some of the steps that we have are going in the positive direction. I think it's going to be a little more time before we see a lot of the alternate A products come out and hit the market, which are non-Fannie Mae and Freddie Mac products, which have looser guidelines. But it's all the flavor of risk and who provides the products. I feel confident the Alt-A market will emerge again. I would like to say sooner than later because I'm at number 10 and I need some more products myself. And that's one of the key things that the Alt-A product market did back before 8. They allowed unlimited number of loans, which is great for people that want to build their inventory. I think that there's going to see some nice changes in the CFPB, which kind of help. They're our sergeant at arm or the police of the industry and the individual that's currently running. I think there's a lot of talk that he may be looking to do something different. And I think we're going to see more of a oversight of that whole department. At one time, I think Mr. Trump said he wanted to abolish it totally. I don't think that's going to be successful, in my opinion. You know, it's there for a reason. It's called Consumer Financial Protection Bureau. Well, then let's go out and protect the consumer. Let's not go out and sue all the banks for the wrongdoings they've done before. We've been doing that for so many years now. We got enough in the kitty. Let's start focusing on the first-time home buyer. Let's get them off the sideline. Let's get them back into play. You know, loosening up a little bit more for investors so they can broaden their inventory. So, I mean, because I've been doing this for a long time, and since 2008, being in the mortgage industry has not been all that much fun. I mean, we had to struggle with a lot of changes, a lot of adjustments, but I really feel confident and very optimistic that we're going to have some really good changes in the next 4 years.
Yeah, and things sure have gotten substantially more loose. Since we first met in person and we were together in Dallas 5 years ago in 2012, you could only put 20% down on your first 4 finance properties that we saw go to the first 6, and now today here in 2017, it's the first 10. Graham, as the lender, do you require a copy of the inspection report?
Well, we don't. Before, on some of the government products they did, but the Fannie Mae and Freddie Mac conventional lending does not. But I highly encourage people to get them. That is only for your peace of mind. It's not something that I am going to orchestrate. It's something you're going to do on your own, and I highly recommend that if you're working with turnkey provider, they usually will have a list of 2 or 3, and they're all going to be about the same, so you might as well go ahead and pick one of those. When you get the inspections back, most of your providers that have gone in and do a full rehab on the property, you know, if they miss something that's of importance, as an example, I had one this week that a couple of windows wouldn't open. Well, they gave the inspection to the provider, and the provider says, fine, we'll put new windows in. They will do that. Where like a regular seller may dig his heel in, you know, from buying a property from a current investor off multiple listing, where all they care about is selling the property. They don't care about making you happy. The turnkey provider does, because they're with you once you close on that loan, because typically they're going to manage that property thereafter.
Yeah, that's a great answer. Well, what should a prospective borrower do before they go ahead and get a hold of you, Graham?
Come up with a strategy. Get with yourself. Get with an accountant. Make sure that this is something that makes sense for you. And then, of course, you know, you have to evaluate, how's my credit profile? Do I want to do it on my own? Do I want to do it with my wife? But all these questions I can answer for you. All you got to do is just give me a call, and I can only give you my opinion. I can only give you what has been successful for other borrowers in the past. And as an investor myself, once again, that's where the opinion comes in. You can reach me anytime. I am truly a 24/7 guy. And my approach to that is, you know, my toll-free direct number is available 24/7. If I'm available, I'll answer the phone. If I'm not, I won't. It's really that simple. So you can call me in the evenings and over the weekends if you have these type of questions.
Yeah, Graham is a 24/7 guy, and he has been my go-to guy for loans for a while, and he really knows how specifically to get income properties done and how to keep things moving ahead. Graham, what states are you licensed to provide loans in?
Let's see, Washington, California, New Mexico, Texas, Kansas, Missouri, Arkansas, Tennessee, Illinois, Indiana, Ohio, Alabama, Georgia, and Florida.
And most of the popular turnkey real estate investing markets for cash flow are in there. Graham Parham, how can our listeners get a hold of you?
Once again, my toll-free number is 855-326-6802. I do have a generic website, but if you want to look on some of my state-specific website, they're all the same. As an example, Texas, it would be TexasInvestorLoans.com. And Alabama, once again, AlabamaInvestorLoans.com, all basically the same, all states represented.
Yep, you can just go to that respective state's website for more information, and that's the website that pertains to the subject, where you want to buy the property rather than where you live. Graham Parham, thanks so much for coming back on to Get Rich Education. It is valuable for us as always.
Thank you, Keith.
All right, so the lending space has loosened up, but you're still going to have to gather plenty of documents for qualifying for an income property loan today, whether that's with Graham's team or whomever you choose to originate a loan with. A seasoned pro like Graham has seen just about everything in 19 plus years of doing this, and his experience can really save you time, money, and frustration. So yeah, interesting changes to the space here with both percents down and reserve requirements loosening substantially, but probably not irresponsibly. And, if you're listening to this episode in the year, say, 2020 or later, like some of you will, well, take today's episode merely as one of historic interest, okay? This is the spring of 2017, and lending requirements do change quite often. So to get access to cash-flowing turnkey property, check out greturnkey.com. And for income property loans, check out Graham's resources. You can go ahead and see his Highlands residential mortgage site, texasinvestorloans.com, for income property in Texas, or, for example, floridainvestorloans.com for Florida. There's a free investor's loan guide, which Graham authored, that you can get your hands on over there as well. Special thanks to today's guest, Graham Parham. His contact information is in the show notes for you. Rich Stat Advisor Tom Wheelwright will be dispensing tax-free knowledge with us here next week. Until then, I'm your host, Keith Weinhold. Although you might quit your day job, don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cashflow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.